Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Okay, let's get started. This webinar is the first in a series of 2 webinars titled The Non-Random Way to Trade or How to Create and Implement Your Strategy. The goal of this webinar is to help you understand and learn all important concepts and ideas beyond any successful trading strategy. Some professional traders with enough experience may trade intuitively, but it doesn't mean that they do not have a strategy. Any successful trader has passed quite a long way before he or she had learned to consistently capture profit from the market. And beyond all that, I truly believe that strategic thinking is quite useful itself, and maybe even not only in trading. First of all, let's take a quick look at the disclaimer. Please beware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using a historical backtest before putting real money at risk. Before we ever talk about trading strategies, let's distinguish mechanical ones from discretionary ones. Any mechanical strategy is 100% rule-based, while discretionary can allow more flexibility in decision-making process. At the first sight, it is easier to trade mechanical strategy because you will never have any doubts, any reflection about your trades, no conflicting information, and all you have to do is to execute upon your signals. But the drawback of this approach is that most of mechanical strategies are unstable. In other words, they all tend to break over time. It doesn't mean that there are no mechanical trading strategies ever, and no successful ones. Nevertheless, they have to design new strategies, examine historical charts over and over again to be able to hold above water. And according to my own trading experience, discretionary trader can outsmart any mechanical strategy because when you have to adapt to ever-changing market conditions, you can be more flexible. And even if you can't figure out what's happening, you always can step back, sit on your hands, and wait until things will become clear for you. But for mechanical strategy, you will either have to switch it off or continue executing upon your signals, so you will not have much choice in case you are a mechanical trader. In this webinar we will focus a bit more on discretionary trading approach, though I will go through both types of thinking. I will do so because the majority of traders are discretionary ones, or at least they desire to be ones. And the first question is, can you make money or take someone else's strategy and trade it for consistent profit? Well, it can be useful for beginner traders who are not having yet any ideas about the market or about trading in whole because they have no experience. But in a nutshell, you cannot be an expert trading someone else's strategy. The majority of professional traders have their own trading strategies, or at least their own variations of any known trading strategy. They know their strategy very well. They have mastered it and they don't drift between trades to make any money. Now, what is a trading strategy? I think that the main misconception about this topic is that traders often think that trading strategy is a formalized rules of entry, exit and position management, and this point of view can be really popular among traders because it is quite easy to understand. You have a pattern, whatever it looks like, you act upon this pattern and you expect to receive anticipated income. In other words, you want to see price going up or down to your target where you can get your profit. Even for mechanical trading strategies, things are a bit more complicated. First of all, it is quite difficult to find mechanical rules that will accurately predict price action in more than 50% of cases. Believe it or not, but it is very difficult to predict exact activity of the market, exact activity of the price action. It is relatively easier to identify basic market condition, which helps us understand how market will likely to behave in the nearest future. On the other hand, we have the price action, which indicates market behavior in the present moment. And we have to combine these two things together in order to stack the odds in our favor. So, even if you design a pure mechanical trading strategy, it has to include some sort of analysis, some sort of predetermined tactical response or a trading plan, and some sort of a money management or a risk management. And only the combination of these points can be called a trading strategy. Basic market condition is something that can't be described in 100% objective rules. That's not that you see, I don't know, price crossing set of moving averages to the upside and the next 30-minute bar closes higher than the previous one. So it's not that objective. Basic market condition can be better described as strong trending, rotational with a trending component, major trending, or overbought or oversold, or something like that. On the other hand, price action, of course, can be much better described in objective terms, like we see 10 candlesticks with rising highs and rising lows, or one bar with lower high to the left and one bar to the lower high to the right. You see, it is much more specific. And trading strategy has to combine analysis, which will help you identify market conditions on the one hand, and rules for entry and exit on the other hand. Money management is also very important, but we will talk about it a bit later. Now, what strategies and methods are available for a trader? It is obvious that you will unlikely be a quant trader employing high-frequency trading algorithms, so we need to search for something real, something that you will be able to execute manually in your trading platform. In this slide, I have provided a list of most popular trading strategies. As you see, we have here two columns with trend following, counter trend strategies, and finally strategies for sideways markets. Well, I have to say that this distinction is pretty much nominal, because any trend looks differently from different time frame perspective. But nevertheless, if you want to make a structure, I would provide you this structure. Well, any trade that you are about to make on the market can fall into one of strategies described below. First of all, we have trend following position trading. You see in the left column, breakout momentum trading and directional swing trading. So these three strategies are trending strategies. Then you can trade false breakouts or make trades against overbought, oversold market, employing one of counter trend trading strategies. And finally, you can take profit with mean reversion strategies and statistical arbitrage. Well, this is not the complete list, and I haven't included scalping here, but 90% of your trades will possibly fall into one of these columns, so let's go through each group in more detailed mode. And first of all, it is trend following position trading with duration of trades more than 1 week and lasting up to several months. It is not an investment approach yet, but it capitalizes on long-lasting trends, or at least pieces of this long-lasting trend. The second group is breakout momentum trading strategies. In this case, you go with the momentum until it's gone. You can have trades lasting from 1 to 3 to 4 days having the strategy on board. And finally, you can employ swing trading strategy that allows you to capture trades with slightly greater duration than for momentum trades. In this case, you are about to wait until correctional phase of a trend is exhausted and make a trade in the direction of the previous trend. You may remember such chart pattern as symmetrical triangle, which shows us that the market is consistently losing volatility. If you ever traded with symmetrical triangle, you are obviously making this third type of trades, and it might look like shown here. You buy here and you are going with the swing. When you hear the old adage, cut the losses short, let the profits run, you should keep in mind that they are talking about trend following position trading. And trading this way, you might have up to 90% of losses and no more than 10% of winning trades and still be profitable. Further, you will see a couple of examples of typical trend following position trades. You may want them to be longer or shorter in duration, but the principle is pretty much the same. First, you have to identify the market condition that you can describe as strong trending. There are several ways to do that, but the simplest way is to use conventional technical or chart analysis. It will take some experience, but the good news is that the longer time frame you are working on, the less noise you will have, and the less complicated your analysis can be. On this chart, you see Australian dollar versus American dollar that was captured some time ago. You can see pretty much clear that this chart was showing pretty strong trending move before. Corrections were not very deep. Price was consistently declining bar by bar, candlestick by candlestick. So we do see here elongated sequence of trending days, not just rapid liquidations to the downside. That's why this chart can be called a trending one, a strong trending one. And the next phase is to find decent trade location for making a trade. Exact methods can vary, but one of the most simplest way to find it is just to build two moving averages with different parameters. One will serve as a fast one, and the second will serve as a slow one. You can find your own parameters for each moving average, or take just 25 and 75 like shown on this slide. It is not a science, so there is no need to find ideal combination, but you have to be consistent with this combination and not to change it once you want to get in a trade. So after you have identified a trade location, you might want to go to the lower time frame and fine-tune your entry. It may look like it is shown on this slide. As you are trading in the direction of a trend, you expect the trend to resume, but you never know the exact moment of a trend to continue. That's why, for trend following position trader, it is more difficult to have smaller stops. If you have once, be ready to re-enter several times before the price will go and your position will bring you some profit. For the previous example of Australian dollar, the continuation is shown on this slide. You see that it has taken for about 2 weeks before price had started to move down, and sideways phase of the market might not be over yet. But if you are trend following position trader, you make your trades based on not upon your predictions, but rather you just know statistically that every strong trend is about to continue, or at least price will lean to the lower side of the chart. So it might continue, or at least price will just go back and forth here. And you can either take some profit within a range or let the profit run, expecting market to go down, setting lower lows. Now the completely different decision-making process is happening when you are trading breakout momentum strategies. Go with the flow, don't nurse the bad trades. If you ever heard similar statements, you can remember that they are about short-term trading strategies like breakout momentum trading. Who are these strategies for? As you are trading with the momentum, you can afford significantly smaller stops in this case. For example, you can have this one, because you really don't want to be with the market that is not moving. And considering that your stop can be smaller in terms of pips, you can afford much greater leverage on the one hand and much greater gains on the other hand. But it doesn't mean that you should necessarily have more risks with greater leverage. If you have, for example, stop loss equal to 15 pips and you can afford to lose $150 in a trade, you will have one full lot for your position. So you can have the same for a position trade. Yet I have to mention that normally you will have more losses trading the momentum in comparison to position trading. So it will be wise to put less risk in a one trade for breakout momentum trading. Trading the momentum, you will first have to find a market with a strong presence of buyers and sellers. In other words, you have to see that the market is being supported. For the sake of convenience, we will talk about support, but you should keep in mind that for the short side you will need to see resistance. And one of the ways to see support is to see the market consolidating with low volatility after the trending day or the series of trending days. You can see what I call elongation, small correctional phase looking like a trading range with a relatively small height. You also might be able to build obtuse angle between impulse and the correction. That is a hidden clue to see a really strong market. But unlike popular idea claims, real support rarely shows itself as a reaction on a single level. Rather, it shows itself as a reaction on a dynamic level. Big market movers rarely do this way, so they rarely accumulate their position on a prescribed horizontal level, considered as a support. If everyday trader will try to buy on the same level, who will be the counterparty for your trade? Once you have seen support, the next thing is to see price confirming your hypothesis. Price will normally come to the higher border of the range with decreased volatility, like it is shown here. At this moment you know that the most of short sellers will generate loss and they will try to exit a trade. Other momentum traders will try to enter a trade. If support was real, market will likely rapidly break the border of the trading range with further acceleration in the direction of the break. That is your pattern for entry. Once you've seen support in the market, followed by confirmation, you can get in a trade with predetermined risk. And that might be your pattern for entry. Of course, price can be perceived as unfairly high by sellers and they might start pushing it down and price will go back to the range. In this case, you just accept your loss and exit a position. But in case the pattern works, you can earn nice profit-loss ratio in your trade. Again, I will remind you that first you have to see appropriate market conditions and only after that you can plan your entry. And eventually, let's talk about trend following swing trading. Unlike momentum trading, where you need to see participation of other time frame buyer or seller, here you will have to see exhaustion. Market loses interest to a given price level or area, and we normally see it by reduced volatility. Very often such exhaustion occurs right in the center of the previous trading range, which serves as a correctional phase. Market just can't spend much time near level of area of low interest. More often than not, such exhaustion is followed by the trending move, either to the upside or either to the downside. We don't know the exact destination. And the key here is to identify elongated correctional phase with signs of decreased volatility. Probably the best trading setups occur when market shows you the least volatility for the period of 3 to 5 days or more, like it is shown on the chart on the next slide. Current volatility can be measured with the indicator like ATR, shown here, or with any other method. You can also just watch 5 to 10 candlesticks or bars with very tight bodies They will show you that market had lost momentum completely and consolidates with very low volatility. When you use this type of trade, your target will be located somewhere outside the previous trading range, like is shown here. When the market lacks liquidity, it will try to escape the previous trading range or the previous area of consolidation and enter the new area. Very often it is a relatively small area outside of a trading range where market is about to gather stops, attract new buyers and sellers, and unlike momentum trading, this trading style will probably not give you fast, rapid price action. Market normally is about to grow or decline in a wave-like mode. So it is pretty difficult to place tight trailing stop for such kind of trades. And also, keep in mind that every time you want to capitalize on changing market conditions, you might select wrong timing, because you never know when exactly market is going to change. In the present example, you also expect market to change from sideways to trending market condition. That's why you can be stopped out several times before you get into a really good trade. Of course, you can wait for some kind of confirmation, but in this case you will inevitably decrease your profit-loss ratio. Okay, now what is about counter-trend trading strategies? They seem to be popular among traders, yet I personally don't think that the majority of traders use these strategies in a correct way. 90% of traders want to capture a reversal of the trend, which is highly improbable. But nevertheless, every market from time to time tends to perform in a manipulative way, generating many false breakouts. Some traders would like to benefit from such kind of market activity. To do so, trader has to identify a setup similar to a setup for breakout momentum trade. But instead of placing a trade in the direction of the breakout, trader steps aside and wait. If the momentum is not accelerating after the breakout, trader puts a trade in the opposite direction. The profit-loss ratio here is similar to momentum trading strategy. As I have said previously, every method of tactical response is not a strategy yet. If you care just about your entry but don't care about making any analysis, you are about to get into trouble very quickly. In example with momentum trading strategy, I paid you attention to importance of correct identification of support or resistance before placing any trade. In counter-trend trading, you don't need to see any support, but you have to see overbought or oversold market condition. In a nutshell, overbought market condition occurs when inventory becomes too long or too short without any participation of any higher time frames. In other words, big market participants are not in the game yet, and market rises due to activity of smaller time frames. And you can assume that the market is being overbought when it grows without any corrections within a period of 3 to 5 days and fails to achieve weekly or monthly extremes. I guess that you understand that it is quite opposite for descending price. And when you see the market resting below the medium-term high, like it is shown on this slide, it is a sign of weakness. Considering that inventory has possibly become too long, the possibility of liquidation break increases. Often such liquidation break occurs just after false breakouts. But the one thing that I want to pay your attention to, it's very important. It is very dangerous to fade the market in strong trending condition. Even though opportunity to go counter-trend can occur in strong trending market as well, but the odds will be stacked against you. So I would not recommend to do this. How one can trade in a sideways market action? Based upon my experience, the best way to do that is to go to the lower time frame and capture breakout momentum trades inside of the range. But also you can, for example, employ mean reversion strategies. They might look similar with counter trend strategies, but mean reversion strategies rely more on statistical studies rather than on price action or market logic. In a nutshell, you will have to identify the idea of a mean, or the average, or the value. Then, after you see the deviation from the mean, you go against the price with pretty distant stop loss and capture a relatively small profit. In most cases you can achieve 1-to-1 profit-loss ratio, but if the market is not very volatile, you are about to have decent percentage of winning trades. You can use also moving average as a substitute of value and measure deviations with envelopes, for example, or Bollinger Bands, or any other indicators. The problem of the weak side, or the weak side of this trading strategy, is that markets are becoming too volatile from time to time, and traders try to apply different filters, or they even try to combine one trading instrument with the other to exclude or to smooth trading component. And you see on this slide that if you apply any mean reversion strategy, it will look very dangerous in this kind of market. It has happened in 2014 when euro has fallen dramatically. In previous slides I have made a quick tour describing possible trading strategies. And the question is, what trading strategy from the list above is good for you? For example, I am more a momentum trader, but sometimes I do small amount of swing trades. According to my own experience, and as far as I know other traders, it's pretty difficult to switch between strategies very quickly and very often. There is a special term, style drift, in an investment industry, in a hedge fund industry. If money manager drifts between different trading styles trying to make any money, it is considered as a worse action than losing money itself. So you will possibly have to stick to one trading strategy, or at least one category of trading strategies, before you will get enough experience to operate several strategies. If you consider yourself as a patient person and possibly you don't have much time to spend near the monitor, you should look at trend following trading strategies. Or if you are ready to trade fast markets, you might consider to be a breakout momentum trader or counter trend trader. But in this case you also need to be patient and emotionally robust at the same time, because in this case you will employ greater leverage and you will experience more emotional pressure than position traders do. To be a trend-following swing trader, you will have to develop good analytical skills and understand market timing. And also you might be required to select trades from different markets, different currency pairs, because good setups will not appear too frequently for this strategy. Trading mean reversion strategies might be good for risk-averse people who want to be right more frequently and to earn modest profit in every trade rather than making monthly profit in a day. What I want to say is that all strategies can work in appropriate market conditions and in the right hands. There is nothing right or wrong in trading. It may be right or wrong for you. So I encourage you to ask a question to yourself. What kind of trader are you going to be? In the next webinar we will talk about testing and validating process. We will talk about trading in a simulation mode versus backtesting your ideas and historical charts. We will try to find key parameters for different strategies, profit factor, average profit-loss ratio, possible size of stop loss and take profit in pips, and other important parameters. Once you know these parameters, you know what to expect and you are able to calculate your risk. If you have any questions or comments to this video, feel free to leave your comments below and I will do my best to answer all of your questions. Please be specific in your questions to receive a good answer. Good luck and see you in the next video.